Hello guys! Today we are going to talk about Alibaba. The e-commerce giant has just released its financial results and there is a lot to unpack. The stock is down almost 4% pre-market. We are going to break down the key numbers, analyze what's working and what's not, and most importantly, discuss what these results means for Alibaba's future. So, grab a seat, get ready to learn, and let's get started. It looks like Alibaba investor didn't appreciate this latest earnings report. The stock is down 3.7% and it could get worse during the day. So let's analyze the key metrics, the key points of this earnings report and try to understand this reaction. So first, let's start with the words of the CEO. Our results this quarter demonstrated our strategy at work. Our focus on enhancing user experience by offering quality products at an attractive price with great service led to stabilizing market share of Taobao and Tmall as we return the business on the growth trajectory. The cloud business achieved positive revenue growth momentum driven by public cloud and AI related products adoption as we continue to invest to maintain our market leadership. I don't like these words, trying to maintain, not growing. It's not what Alibaba investor I used to. We are always using to see the company grow at a faster pace. In this quarter, we continue to invest for growth in our core business while reducing losses in other business units through operating efficiency. We maintain the integrity of our margins and deliver consistent adjusted EBITDA. We also return significant value to the shareholders at a pace higher than past quarter. We made $5.8 billion of share repurchase that include a concurrent repurchase of shares in connection to our convertible notes offering. This is the words always trying to look what's good and what's bad. So let's start with what's bad in this report. First, revenue. The company Alibaba just grew 4% year on year. I've said just because it was expecting to grow around 6%, 7%. That is a growth rate that Alibaba investors, analysts are expecting, and it was not good. At least in my opinion, I was expecting a little bit more, but there are some good growth in the company, but Tmall and Taobao was a bad report. Another thing that I didn't like was net income that was down 27%. I know Alibaba is a cash cow. They are having really good margins, good free cash flow margins. They basically, the last year, they had a free cash flow margin, a free cash flow of around $20 billion, which is really high when you compare to the market cap of the company. So Alibaba is trading at a lower valuation, a low PE, or they have a high free cash flow yield. But this quarter was not good when you compare year over year. They say this is partly offset by the mark-to-market changes from our equity investment. But if I'm not wrong, last quarter it was the same thing. So investors might be a little disappointing. So they were expecting at least the same net income or free cash flow. So that is a bad thing in my opinion. Revenue growth was lower than expected, and net income was lower when you compare year over year. So that's not good. They talk about the different segments, but one thing that was really good this quarter was share repurchase. It was a record quarter in share repurchase. They bought back $5.8 billion. This is, I would say, 2.5 or 3% of the company in one quarter, which is really high, and that's the best thing to do, and it is something that I'm expecting Alibaba to do in the next few quarters. And being down 4% can be really good for this share repurchase. So nothing is bad with this report and this the stock price to be down. So I'm expecting Alibaba to continue to go down. So talking about the revenue, as we have talked, only 4% growth, and net income was 27% down. But If you use non-GAAP net income, it was only down 9%. That's why they talk about mark-to-market securities. I think that was what was their meaning. But what is really important is to look into the different segments of the Alibaba. The biggest segment is Taobao and Tmall, the e-commerce on China, which is where almost half of their revenues come from, and that has been the crowd jewelry in the latest quarter. We have seen Alibaba in the previous quarter to not seeing cloud growth, but Taobao and Tmall has been really strong, and this quarter the revenues of this segment is down 1%. So I'm a little bit disappointed, and this is the major reason that Alibaba has disappointing investment in revenue. It's because Taobao and Tmall, and that's a little bit bad. It could have some pressure from competition, from JD, maybe from Pinduoduo on China, and that's nothing we like to see. So we want them to maintain their market share, to continue to grow at. They will not grow fast because it's a big segment. They already have revenues of 15 billion dollars in one quarter, which is really big. But I'm expect them to grow at a slower pace, but a healthy growth. And being down, it's not good news. And this is probably the main reason why the stock is down. Cloud intelligence, actually, we don't see a high growth. They grew around 6% year over year, but this is a reacceleration of the growth. Bear in mind in the previous quarters, they have been not growing or growing around 1 or 2%, and we have seen a major growth in their cloud business based to AI related product that is growing triple digits year over year. So that's good, and I do really believe we can see this growth to reaccelerate because they are investing a lot. AI is becoming a big thing on China as well. So, and cloud intelligence group from Alibaba will be a bigger beneficiary of that. International commerce has been really good for Alibaba, growing around 32% year over year, which is really great. Cainiao as well, growing around 16%, really good. The digital media is not growing as well, but overall their revenue segment was around 4%. But if you take into account the intersegment elimination, they only grew around 4%, which is not good. So overall, looking at this, revenue and net income was a major disappointment, mainly due to Taobao and Tmall revenues being down 1%. Intelligence Group Cloud is showing some signs of reaccelerating their growth, and it's something that I already talked in this channel. I'm expecting them to continue to grow, and it could be a big segment of Alibaba in the future, and I believe in that. That's one of the reasons I like to invest in Alibaba. Cainiao and international market remain strong, really good growth, and overall it was not what I was expecting. I was expecting a growth in the revenues a little bit higher, but overall I would say that's nothing much changed on Alibaba. Share repurchase, they bought back a lot of cheap shares during this quarter, and the shares outstanding continued to go down. And when Alibaba started to reaccelerate their growth, and when everyone will be willing to invest in China and on Alibaba, these shares outstanding going down will be really accretive value for the shareholder at that time. So that's what they should be doing, and they are doing the right thing. They are investing in their future, in their company, and investing and distributing some cash in excess to the shareholders by this share repurchase program, and doing some dividends that they didn't do anyone this quarter. But overall, I continue bullish on this company, even though this report was not the best. But this is my opinion. This is the key takeaways of this latest earnings report from Alibaba. Some good things, some bad things. But overall, this is what happened in the company. So I hope you like this video, guys, and please like and subscribe. See you next time.